Welcome to another edition of the Up Your Assets podcast, hosted by Ray Ferrara, CFP founder and executive chair of Provice Management Group, LLC. The following presentation is for general information purposes only and not personalized advice. Seek out a professional before making any financial decisions. Additionally, no guests pay to be on the show or are paid to be on the show, and the opinions expressed are their own and not the host's or the show.
Hello and welcome to another edition of the Up Your Assets podcast. Happy New Year and welcome to 2026. I'm your host, Ray Ferrara, and today's going to be a fun day because I will make a fool of myself not only today, but throughout 2026. And how am I going to do that? Well, I'm going to make some predictions about what will happen in the year ahead. Sure, it's easy to make a fool of yourself, but it's hard work. Yogi Berra said it best. Making predictions would be easy if it wasn't about the future. But what the heck, we'll try anyway. But before we do, here are some serious thoughts about predictions and why you should be so careful about putting too much stock not only into my predictions, but any that you might hear. It is widely considered a folly to make definitive predictions because of the sheer complexity and the inherent unpredictability of the world. Human understanding and computational models are inevitably incomplete. They cannot possibly account for the vast network of interacting variables, many of which are known or unknowable. History is replete with examples of confidently made predictions that failed to materialize, from economic collapse forecasts that didn't happen to technological advancements that were completely missed. The folly, therefore, lies not just in the high probability of being wrong, but in the potentially harmful consequences of adhering to a rigid view of an inherently uncertain future. Instead of relying on a crystal ball, a cracked and foggy one, a more prudent approach involves developing resilience, embracing adaptability, and making informed decisions based on a continuous evaluation of current conditions and then potential scenarios. Now, what with those caveats, here goes our predictions for 2026. First, 2026 will be the year of the IPO. After many years of very few initial public offerings, IPO for short, 2026 will see a continuation of a turnaround. In 2024, only 224 IPOs hit the market, but in 2025, that saw more than 350 and raised just under $50 billion. That pales in comparison to 2021, which raised over $150 billion. Look for 2026 to approach 500 and a minimum of $100 billion. With the passage of the Invest Act, which we believe will pass Congress early in 2026, the path of an IPO is made much easier. Some of 2026's IPOs could be big, and we mean big. Besides the two most important mortgage companies, Fannie Mae and Freddie Mac, which the government took over during the Great Financial Crisis or recession, it is possible for Elon Musk to launch, pardon the pun, SpaceX. But all will not be rosy. The markets may have a problem capitalizing all of these companies, and if they do, it might keep the more established companies in the S&P 500 and other indexes from advancing as much as they might have otherwise. There is always limited capital. Second prediction: private markets will continue to lose their appeal. Sure, they'll still be around, but it comes as no surprise to any investor that private markets, and especially private equity, that it's been a tough 3.5 years. With the Federal Reserve raising interest rates to fight inflation, the days of easy and almost free money came to a halt. Private markets soared following the Great Recession, providing outsized returns and cash flow. But now investors who expected a return of some, if not all, of their cash are becoming increasingly restless as deal flow has been minimal compared to previous years. Private equity managers are scrambling for ways to keep the gravy train going. Make no mistake that some will do well, but others are going to lose money for their investors and themselves. In an effort to find ways of creating liquidity, some managers have created new funds, raised money, and then bought the assets of some of the previous forms, but not necessarily all of them, from the old fund. They cherry-picked the good companies out of the old fund, which provided cash to give to former investors, but it left behind those companies that no longer show promise. Thus, the returns are not approaching, for the most part, those of the past. How can a manager represent both sides of the transaction and be totally fair to both? Not possible from my vantage point. Some have therefore turned to the public markets, trying to convince investors that the best way to get to liquidity. But guess what? Public markets have hammered many of these, especially in real estate and some private equity, by reducing the price, in some cases dramatically. Worse, the private markets are now trying to attract money from far less sophisticated investors and even in 401k portfolios. Our prediction is that the private markets are going to have more negative publicity than positive, and that they will continue to bleed. So much for the idea that private investments help dampen volatility. And now, prediction number 3. Patience will be needed. We expect volatility throughout the year, but especially during the first 3 or 4 months. There is enough consumer negative sentiment out there as the economy continues to separate the haves from the have-nots in what is now referred to as a K economy, where some move forward as others are pressed down. A downturn in the beginning of the year is likely, but the biggest mistake that investors can make is to panic and sell out. Why? Because there are lots of currents underneath the economy and the markets that point to a reasonably good year. Companies are coming off of a year where profits were higher than expected, and their guidance is generally positive going into 2026. While prices are not going to decline, the rate of inflation will slow as the comparisons starting the middle part of the year will look good. The one big beautiful bill is a factor, as tax refunds will be higher than the years before, freeing up cash for consumers, and then 100% depreciation on new equipment will do the same thing for corporations. Finally, the debate is not over whether the Fed will reduce interest rates, but by how much and how often. Rising profits, less acceleration of inflation, and lower interest rates set up a modest but up year. Look for growth of 3% in gross domestic product, GDP, plus or minus 25 basis points. Prediction 4. Inflation will slow in 2026, but the prices are not coming back down in any major way. Inflation has been coming down over the past few years from its high point of 9%. We are finishing the year at about 2.8% increase in prices for the year, and much of this is directly tied to the tariffs in our opinion. In 2026, some tariffs will come down, others will go up, but the major effect of the tariffs on inflation are behind us, starting in the late second quarter. Okay, so we're not going out on a limb when we say prices are not coming down, for the most part, but they will not be going up as fast. Look for inflation to be at an annual rate just around 2.5% by the end of next year. Hard to see it lower given the strong economy ahead. Prediction 5. Interest rates are coming down, and they will likely be at least 2 rate cuts in 2026. We expect one more rate cut under Jerome Powell as chairman, and then at least one more later in the year from the new Fed chair. It would surprise us to see the new Fed chair do it at his first meeting, as he will not want to be called a lackey to the president. These lower rates will be beneficial to all, but mid and small cap stocks could shine. Interest rates on long bonds may go higher as the bond market keeps its eyes on the U.S. debt and inflation. The strong economy is going to make it hard for the Fed to do more than 3, which could still happen. Prediction 6. What about the AI play? It'll slow, but it isn't over. By the end of the year, the major players in artificial intelligence will need to show some results for the last 2 years of massive capital investments into chips, data centers, electricity, and water. Yes, water. The dirty little secret that no one is talking about is the volume of water needed. Did you know that it is estimated that every question asked of AI requires 1 pint of water to keep everything cool? Surprised? You probably are. The investments will continue, but the companies have to show a return on the investment of capital, and they need to show it by the end of 2026. The AI play is definitely going to have losers, but most of these will be in startups. On the other hand, we think many of the survivors will become healthier, and many will be acquired by the big players. Most of the big players will see the stock move down from recent highs early in the year, but far from crashing before moving forward during the course of the year, but not at the same crazy moves to the upside. Prediction 7. Financials will do well. Given that interest rates are coming down and initial public offerings will increase, banks and most financials should do well in 2026. Banks will be more open to loaning to small and mid-sized companies. Even with interest rates going down, more money is being deposited into banks. People are building up their emergency and opportunity fund after depleting much of their savings prior to 2025. Many are also afraid of the volatility of the stock market and will seek the security provided by banks. Prediction 8. Okay, how can we not talk about the upcoming November elections? The off-cycle voting in November of 2025 clearly showed a shift to Democratic candidates, but not as much as the media made it out to be, and certainly not what the Democrats have claimed it to be. If the Democratic Party can avoid an onslaught of the very liberal part of the party, ousting more central members in the primaries, the Democrats will definitely win the House by ousting at least 20 Republicans. If they can't, they'll still win the House, but only by a few votes. The Senate will remain in control of the Republicans, so it's going to be 2 years of not much getting done. And don't forget, the White House is still in the hands of the Republicans until 2028. Well, prediction 9, this is a group of one-liners. Here we go. More companies will leave the New York Stock Exchange, or they will choose to do an IPO on another exchange, both of them following the footsteps of Walmart. The stock market will produce a gain for the 4th year in a row, a feat it has only done once before from 1995 to 1998. Precious metals will continue their own bull market. Bitcoin will set a new 6-month low before it goes higher as speculators rotate away from the risky trade. Stablecoins will increase in use for financial transactions. Trade wars continue, with Europe testing Trump's patience as it relates to tech stocks. China continues to stall its commitments, and India flexes its newfound muscle. Oil will go up by the end of the year by 10%, as worldwide tensions remain an issue in Gaza, Ukraine, and Venezuela, to name a few. Even if they're all solved, something else is going to happen. Now, on a personal level, you will find it much more difficult to complete your tax return than you have in the past. Not that it was easy before, but because of the one big beautiful bill, for those that have to worry about their taxes and all the things that need to be integrated because of that bill, it's going to make it more complicated. Now, for those that have procrastinated doing or updating your estate plan, you're going to get off of your butt. Okay, yeah, we'll say it. Get off of your ass and do it now. For our final and most likely to come true prediction, because the world is so interwoven, it is what we don't know or anticipate that will keep things changing and always will upset these and other predictions. Please use these thoughts to help stimulate those of your own. You need to remain adaptable and not hung up in your own predictions. It's okay to be wrong. It isn't okay to acknowledge your mistakes. If you do, then things will not likely end well. We want to wish you a healthy, safe, and prosperous new year in 2026. Now, go out there and up your assets.